Hello, Mr. and Mrs. Salazar. I'm happy that you could join me today for your financial plan review. Right now, we're just going to be going over two parts of it for you that I have highlighted for further review. First, me as Salazar, we're going to be talking about your Section 403B TSA. You had asked me about the capital asset pricing model and how the performance of your TSA is doing relative to what it should be performing given its risk. So the capital asset pricing model, or CAPM for short, is a formula that we can use to figure that out. Basically, RI is going to be our expected return, RF is the risk-free rate, and beta is the relative measure of risk for the portfolio versus the risk of the market. Now, beta, if it's above 1, it means that there is more risk added to the portfolio than there would be in the overall market, and a beta of less than 1 would mean the opposite. It would mean that your portfolio has less risk than the overall market itself. Now, we see here that the average return of the market is 12.41%. So we should keep that in mind when we go through this formula. So locking in the various integers here, we come out that RI is 16.67%. What this means is that given the level of risk for this portfolio, your expected return should be 16.67. However, the risk of the market itself is 12.41%. And if we look through here, we actually find that the average rate of return for your own portfolio in the TSA right now is only 11.5%. What this means is that with risk involved, you are actually underperforming versus what it should be returning to you given your level of risk and the other market scenarios. So moving on here, you had a question about what the maximum amount is you can contribute to your TSA for 2018, and that amount would be $18,500. There is a 15-year catch-up that you may be able to qualify for of $3,000, but that's something that you would need to check with your plan administrator about if they offer, and assuming they do offer, you would qualify for that. Now, your annual additions limit for the TSA is the lesser of 100% of your earned income, or $55,000. Now, given your earned income, this means that you are able to contribute $55,000. And if you have any questions about this, I'd be happy to go over it with you the next time we meet. Now, moving on, I was taking a further look into your overall portfolio with you and Alex, your IRAs, your stocks, etc. And there were a few things I wanted to mention to you. Over here we have beta, alpha, and R squared. As I mentioned previously, beta talks about the risk relative to the market. Alpha looks at the performance of your portfolio versus the performance of a given benchmark. And R squared is the correlation with that benchmark. So how closely is your portfolio tracking that given benchmark? So I went through and I found a few different holdings in your portfolios that I think require some additional attention, and I'd be happy to hear your feedback about this next time we meet. But starting with stock C, I noticed that the average return is actually negative. It's minus 5%, and its beta is 2.55. Its R squared is 50%. So if we look at this, a beta of 2.55 means it's very much riskier than the overall market. And we see that its R squared is 50%, meaning it has a low correlation with its benchmark. That, combined with the fact that the average return is negative, when the overall return of the market, as we see here, is positive 12.41, indicates that this holding may not be something you would want to consider to continue holding within your portfolio because of its negative performance. Moving on, we have mutual fund C. And we see with this one, it has a higher expense ratio. Now, expense ratios for mutual funds talk about basically the cost of running the fund, and the higher the expense ratio, the more long-term earning potential you lose because that expense ratio is being taken out of your return over the long term. So the expense ratio of this fund is 1.22%, and its average return is 12% actually. But if we compare that to mutual fund A, we see that mutual fund A has an expense ratio of only 0.14% and an average return of 13%. So what this tells me is that you may not be seeing the return that you would require from an expense ratio as high as 1.22%. This tells me that the fund managers may not be adding that value there when you have another fund that is performing better with such a lower expense ratio. In addition, we note that this fund, Mutual Fund C, has a negative alpha. Negative alpha, performance versus the benchmark, indicates that it is underperforming its given benchmark. So it's another thing you may want to consider about removing from your portfolio. Finally, stock F. I'm going to leave this up a little bit more to your own discretion. But stock F, you have an unrealized loss. The basis is $6,000, and it has a current fair market value of $5,402. It does have a slightly high beta of 1.1, however, that is very close to the market performance. And it has a lower average performance than the overall market. Its performance is 7.2%, whereas the market is 12.41. So we see that going forward, it may start to perform better. However, at this point, it does have that unrealized loss that you may want to be able to take advantage of. So that's all that we're going to discuss today, and I look forward to speaking to you in the future.